Global GDP decelerates by 108 basis points. Oil sinks to as low as $50 a barrel. Major global equity indices tumble by more than 20%. There are three possible outcomes from the scenario framework created by UBS Global Research to assess the potential impact of ongoing trade disputes. Three scenarios were created. Implemented, where the recently announced tariffs are implemented fully by the US and China responds in kind. Escalation, where the US imposes a 10% tariff on an additional $200 billion of Chinese goods and China responds proportionally. And trade war, where the US retaliates to China's second retaliation. The scenario assumes a 30% US tariff on all imports from China except smartphones and a 30% Chinese tariff on all imports from the US.
An all-out trade war may mean global growth could decline by as much as 108 basis points, essentially a retreat from about 4% to 3% global growth. Growth declines in the US and China would be larger, but this is before the effect of any policy response. The largest impact will come from supply chain disruption, job multipliers, the effect on confidence, cross-country spillovers, but those are inherently difficult to model, and so one should place large uncertainty bands around our numbers.
Any drop in global GDP will hit oil prices. The more extreme trade war scenario could take prices as low as $50 a barrel in 2019.
Our analysis shows interest rates, in particular those in the US, will be hard hit. However, those interest rate declines could have a surprisingly small impact on the dollar, as risk-off episodes are often associated with dollar buying. On balance, we foresee a slightly weaker dollar in both the escalation and the trade war scenarios.
On equity markets, stocks could be hit comparatively harder, especially as some aren't yet discounting a trade war scenario. In the States, UBS estimates that the S&P 500 would fall by around 10% in an escalation scenario and slump roughly 20% in an all-out trade war. An escalation of the trade war is already being priced into Asia ex-Japan equities. But a full-blown tit-for-tat could see 24% further downside on Asian stock markets. European markets are also already pricing a degree of escalation of trade tensions. Under the trade war scenario, European bourses' greater international exposure could mean Europe underperforms despite being something of a bystander in much of the dispute. So what should investors be watching over coming months? The US needs to confirm the level of the tariff that it will impose on $200 billion of Chinese goods. Although originally 10% was the number being considered, the US Trade Representative is now formally considering a tariff as high as 25%, and China would then need to decide whether to retaliate. UBS thinks it will, but not fully in kind, and doesn't believe the exchange rate or China's large holdings of US Treasuries would be used as weapons. The possible US retort to that response from China is unclear. If de-escalation isn't chosen, an all-out trade war becomes possible. Sometime after that, possibly by the end of the year, we could get an announcement on global car tariffs from the US. Finally, Nafta. Unless miraculous progress is made in the next few weeks, UBS expects the renegotiation on Nafta to drag on past the US midterm elections. Ultimately, a so-called Nafta light will likely be agreed with no major departures and some new sectors covered. But with all the other trade negotiations taking place, that may not happen until sometime in 2019.